The S&P 500 has had an incredible gain of 25% in 2024, but the real question is, what's next for 2025? Could we see the rally continue, or are we on the brink of a major correction? Recently, the S&P had experienced a very sharp 4.5% decline in a single day, and one of the primary drivers was the Federal Reserve's updated dot plot, which showed a more hawkish stance than expected. The dot plot is a visual representation of where Fed officials expect interest rates to be in the future, and this revision suggests that further rate cuts might be further away than markets initially expected. Additionally, comments from Federal Reserve Jerome Powell reinforced this outlook, signalling a potential halt in rate cuts for the foreseeable future. These developments heighten fears of prolonged tight monetary policy conditions, leading to the sharp decline in the S&P 500. Despite these challenges, the market staged an impressive recovery. One of the key drivers was the strength of earnings from major companies, particularly in the tech and consumer sectors. These results provided reassurance to investors, showing that businesses are adapting well to current economic conditions. Another major factor was the significant buying activity at critical technical support levels. As the market reached these levels, a mass amount of buying activity surged. This is a typically normal thing to happen when we have such a sharp decline. So, could the S&P 500 go even higher? Several factors suggest it's possible. The labour market remains strong, supporting consumer spending. Corporate earnings continue to demonstrate resilience and growth. And as long as inflation remains under control, the chances of a rate hike happening are slim. These factors support a potential continuation of the current bullish trend in the S&P. Additionally, the global supply chain has shown signs of stabilisation, easing pressures on input costs for many industries. Increased business investments in AI and green technologies are also fueling optimism, creating new growth opportunities for some of the major S&P 500 companies. Low unemployment rates continue to drive consumer spending, which accounts for a significant portion of the US economy. Combined with the recent moderation in inflation, these factors create a strong foundation for further gains. Despite numerous articles predicting a correction, there is still potential for further upside as it stands. But we're not out of the woods yet. Several factors could trigger the next major correction. Let's start with geopolitical risks. Current tensions, such as the ongoing conflict in Ukraine and increasing friction in the Middle East, could escalate further. These geopolitical events have the potential to disrupt energy markets, heighten global uncertainty, and weigh on equities such as the S&P 500. On the economic front, the Federal Reserve isn't suggesting rate hikes right now, but that could change if we see a significant increase in inflation or other unexpected data from the labour or housing markets. If that does happen, that may force the Fed to tighten monetary policy further, and this would likely spook investors and weigh heavily on equities. Another looming factor is the maturity of over $7 trillion in US government debt over the next 12 months. This is happening because much of the short-term debt issued during recent years is coming due. As the government rolls over this debt into higher interest rate environments, it will put upward pressure on borrowing costs, which could crowd out private investment and weigh on corporate earnings. This scenario could lead to downward pressure on the S&P. Another key factor is corporate earnings, as a string of disappointing reports could lead to downward revisions in growth expectations, adding to the bearish sentiment. And finally, watch for deteriorating consumer confidence. If consumers pull back on spending, that could also signal deeper economic troubles ahead. So, to summarise, what you need to pay attention to in order to navigate the next market correction are escalating geopolitical tensions, unexpected inflationary pressures leading to higher interest rates, large-scale debt maturities, disappointing corporate earnings, and weakening consumer confidence. By staying informed on all of these factors, not only can you navigate the risks, but you can also capitalise on these movements. With so many moving parts, it can be hard to keep up with all the important data and information, but the fact is, it's a necessity. If you think a correction is on the cards and you're looking to capitalise on it, then you can't afford to miss out on any important information. If you want to stay ahead of the curve, then be sure to join our free Discord server in the description below. You'll get access to real-time updates, exclusive trade ideas, weekly market breakdowns, and answers to any questions you may have. Whether you're a beginner or an experienced trader, you'll find valuable insights to sharpen your edge. Click the link to join now.